Let's talk to Patrick Reid. He is the co-founder of Adamis Principle. Morning to you, young Patrick.
Hello, morning.
Right, we've got three thought-provoking slides. Let's kick off without further ado with the first one. We've got the euro against the US dollar, a daily chart. What are your thoughts at these levels?
Very difficult to read. I'm really in a point of conflict here, Nick. You know, on the one hand, you've got, the price action. You've got what was close to a triple bottom at 115, the big fig. The third time, I think the low was 115.26, right? This is very solid. This is a really good base. And we're now flirting with 117.20, which is a bit of a cheeky level in itself. See, this is great. This is, price is king, price is never wrong, all the rest of it. However, you've got a pristine US macro picture, okay? You've got GDP annualized at 2.8, a touch softer than the Trump ideal at 4, but really good. It's an upward sloping indication. You've got ISMs, good actually, been pretty good this week so far. Slightly softer, however, this is not through lack of demand, aggregate demand, it's through supply, which isn't that bad. You've got full capacity on jobs. You've got, in addition to this, I've got, I know a man with some very clever models saying PCE, the Fed's preferred metric, and CPI, all set to explode higher. Why? The budget, it's got to be spent around 100 yards. It's got to be spent by September, right? So this is conflict. What I will say is, as you know, price is never wrong, but the only time I'll say it's wrong is 118.50. That's when I'll be getting to be selling euro dollar.
Okay, so let's take a look at the second slide. The financial conditions index, the Chicago Fed. What is this telling the crowd?
Okay, so everyone's talking about the rate hikes around 3 to 4 a year in the US. Everyone's talking about QT, whoopie-doo. Okay, we're still in a very, very easing environment, and this index tells us that. Okay, so the Fed is way, way behind the curve. The recent minutes are basically thrown out another indicator, which is the spread between the 2s and 10s, to, in my opinion, hang a more hawkish hat in subsequent meetings. This is all supportive of the dollar, obviously, but at the moment, this is just a bit of a reality check. This chart is basically, it's from the Chicago Fed, and it's basically saying, yes, we are hiking, but the other indicators like the 30-year Treasury yields, like the spreads between the AAA and the ABB, all of this is still very, very easy.
Okay, so let's move on to the last slide. We've got the dollar yen on a daily. This looks a really messy chart to me.
Thanks, yeah. I'm glad I'm not the only one. This is really probably the most difficult chart to read. And, I've been doing this a long time. And, I tell my students, oh, this is how you read a chart. I don't know. Positively, I've got very little conviction on this, and I'll tell you why. Because obviously, it's trying to go higher, but 110.20 is the key to stay above. It's chopping on the daily, it's chopping on the hourly, it's chopping on the 4 hourly. And why is that? Well, there's lots of risk on and risk off happening. Like I said, the US side, the macro picture is very good. But you've got EM outflows, you've got obviously trade wars, you've got the renminbi taking a long bath, that's affecting flows on risk. And all of this just paints a very difficult picture. I want it to do something. It's a bit like having an unwanted guest at a dinner party. You want him to actually do something, either leave or entertain. But at the moment, he's just stood in the corner doing nothing.
Beautifully put. Well, I won't invite myself round to your house anytime soon. So really, as we know, there are the old Japanese used to say, there's times to buy, times to sell, and there's times to do nothing, okay? In terms of the euro and basically the dollar yen, this is probably a time to rest, isn't it?
It's certainly a time to rest, but not on your laurels.
Yeah, understood. On that note, Patrick, thank you very much indeed.
Thank you.